Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. Just an hour to go until the closing bell, and stocks rising here. The Dow and the S&P 500 eyeing record closes. Our very own Jared Blickery is standing by with the headlines. Jared.
Thank you, Josh. We got a ton of records to talk about. Not in the NASDAQ, but tech is definitely doing its job here. Let's check out the Dow first. That is up 238 points, 55 basis points, about 0.5%. Only a few minutes in the red in the early goings, but for the most part, just treading water in the afternoon, holding on to those gains. You can see under 500 points from 50,000. We got some hats over at the New York Stock Exchange. I know Peter Tuchman has them ready to whip out whenever they cross that milestone, but not today probably. NASDAQ Composite up almost 1%, pretty close to the highs of the day here. Also spent a few minutes in the red early on in the day, but this is non-farm payrolls day, the big jobs day, and the data wasn't bad. And finally, it was on time again. So I think investors are just kind of saying, a relief, right? And this is a relief rally. So S&P 500 up about 0.75%. I also like to look at the equal weighted S&P 500. That's up just a little bit less than that. Russell 2000, by the way, another record intraday high. I should also mention S&P 500 and its equal weight record highs. Russell's up about 0.7%. Microcaps are at a record. Dow Transport's at a record. So the list just goes on here. We got a lot of records. In the bond market, though, things are just pretty steady. We got the 10-year T-note yield down about 1 basis point to 4.17%. That is good. We don't want to rock the boat here. 30-year also down 4 basis points to about 4.82%. And the U.S. dollar index up ever so slightly here. And let's check out the sector action. Tech has been in the forefront, kind of jockeying for position with materials there. You can see each of those up about 1.5%, but we got utilities close on their heels. Big meta deal with Oklo and also Vistra. So we'll have to see how that plays out into the close. Then we got industrials and consumer discretionary and staples. All of those up more than 1%, all of those outperforming the S&P 500. What's not working today? Healthcare and finance. But healthcare has been doing pretty good lately, not so much today. And let's take a look at the NASDAQ 100. We got a lot of green here, a lot of dark green, and I'm gonna flip over to the semiconductors because that is where the dark green, those outsized performers to the upside are concentrated. And if I sort by performance here, you're gonna see SanDisk up 14%, APLD, there we go, Applied Digital, that is up year to date. Let me just show you this, up 54%. So a lot of these names just blowing it out of the park. And here's the software, not terrible, but that's definitely a different look than we're seeing inside of semiconductors. And that's kind of the trend we've seen recently. I'm going to end off here on the Dow. It's not just some mega caps. We got some of the others performing quite well today. Home Depot, that's a consumer discretionary stock. I said that was one of the outperformers. That's up 4%. Caterpillar, Boeing up 3%. Honeywell, even Sherwin-Williams up about 3.5%, Josh. So a lot of records around.
All right, thank you, Jared. Well, stocks rising on the back of that December jobs report. Let's delve into it now with Jefferies chief U.S. economist Thomas Simons and U.S. Bank Wealth Management senior investment strategist Rob Haworth. Guys, welcome to you both. Thomas, my friend, you're the economist on the panel, so I'll start with you. The jobs report, Thomas, headline a bit weaker. Unemployment, though, does tick down to 4.4. Your response to that report, Thomas, what'd you make of it?
Yeah, you really do need to dig well beyond the headlines these days in order to really get a sense of what's going on with the labor market data, because just looking at the headline jobs creation numbers doesn't really give you all that good a feeling about what's going on in the labor market. Still seeing pretty subdued, job growth, well under 100K. Didn't get a rebound that I had been expecting this month in terms of government workers coming back. It looks like that big drop that we saw in October really was the result of a lot of those DOGE deferred resignations. And, the one good thing that we see in this data is that there's been kind of an arrest in the accumulation of slack that we have been seeing in the household survey and some of the longer term measures of unemployment in recent months. Those, although they had deteriorated over the summer, started to level off here in the last couple months and really showed some decent signs of improvement here in December.
Rob, I want to bring you in here as well. I know you looked through it through a different lens. Rob, what'd you make of that report? What do you think the Fed made of it, Rob?
Yeah, I think it was a good enough report that tells us that the consumer remains healthy, right? Yes, we're not seeing a lot of job creation, but we are seeing wage growth continue up 3.8% year over year. We're seeing job creation and we're seeing a lower unemployment rate. So we think that means the consumer can keep spending. And that's what's going to support earnings season. As we head into fourth quarter reporting here, we're going to get a better look. But we think that this report really continues to support that consumer. It probably leaves the Fed a little bit on hold, right? They got some good news here. Wage growth is high. The labor market's more solid than they thought. So they maybe don't have to make a move in January and they can continue to wait and see and evaluate the data as it comes in, with the next key data point being next week's consumer price inflation data.
How many cuts, Rob, in 2026? What would be your base case?
Yeah, we think there's probably a couple to come, but they won't be early and they won't be quick. And I think really when we think about that couple of rate cuts, it's really because there's a wide dispersion of potential outcomes here, right? That if we see a surge in this economy, the Fed may not have to do anything, right? And certainly we have some good news around that when it comes to consumer stimulus coming around tax time, more spending as we get into summer, particularly with the World Cup. Right, but if we get some more uncertainty from the government shutdown, other issues, right, that could take us to the other side where the Fed does need to do more to support the economy as we move ahead.
All right, Thomas, we got 2 cuts on the board. 2 cuts, that's the base case. So is that dovetail, right, Thomas, with your call?
Well, I think it's actually more or less a mirror image, because I think that you can make the argument that they should be continuing to cut in the short term and then can let the economy kind of take care of itself in the second half of the year and beyond. I think that that slack that has stopped building up in the labor market, that's the thing that tells them they don't necessarily need to act with a great sense of urgency to lower rates significantly, with successive cuts here and there. But I think that when you look at that really narrow breadth of hiring, still that very extreme concentration in leisure and hospitality and in private healthcare jobs, what it tells you, I think, is that there's not a lot of small business creation. That's not creating a lot of jobs, a la the way we're typically used to expansion cycles in the labor market. And that probably means that interest rates are playing a role there, right? The financial conditions, for large companies that borrow in syndicated markets, those conditions are very, very good. But when you consider that small businesses are still going to be, trying to access bank loans with revolving rates, and they're subject to interest rate risk, I think that a few cuts, 1 or 2, maybe one in March, one in June, would really start to get things going. And then that would dovetail with the fiscal tailwinds to get us to, some really good growth in the second half of the year. If productivity continues, we could even have that without too much of an inflation risk either.
Rob, so we got the jobs report today. Here's one thing we didn't get. We didn't get the Supreme Court ruling on those tariffs. We will get it, Rob. Let's do a hypothetical. Let's say the Supreme Court says, you know what? Those Trump tariffs are illegal. I'm curious, Rob, how you think the market, stock market, bond market, would react to that.
Yeah, I think it really depends upon how they characterize the repayment or not. That could be the thing that really upends the market, is if the government has to scramble to repay pretty quickly. I think in the end, what we see is that tariffs are probably here to stay. There are many other mechanisms, and the administration can pivot fairly quickly to get 15% tariffs in place using other methods, at least for the next 150 days, until they can do more permanent methods. So the IEEPA ruling will certainly undermine and maybe create some short-term uncertainty, but in the long term, it seems like businesses as well are starting to adapt to the fact that tariffs are probably here to stay.
Thomas, I'll ask you the same question. I know you're looking at it a bit differently. Supreme Court, Trump, tariffs, Thomas, what could be the effect on the macro?
So I don't think that it's going to be a huge effect on the macro in general, because my sense is that it's very unlikely that they're going to come up with a ruling that actually forces the government to do some kind of rapid repayment. Now, obviously, if that does happen, then you have this issue where the Treasury is probably going to have to issue a special amount of bonds. There's going to be a huge back and forth trying to figure out who owes who what and how much. But if there are just kind of end around methods that the administration can use to try to essentially apply the same policy with different justification, I imagine that there will be some room for that, no matter how the Supreme Court rules. And I do think that we are in an environment now where the market has become more comfortable with this idea that tariffs are going to be here to stay at these moderately high levels. Levels that would have been considered very onerous not that long ago. It seems to be that the economy is rolling along just fine. I think that the one issue is, though, if they do run into kind of a time crunch and they need to work with Congress to codify new laws that are going to allow the administration to apply these tariffs, they would have to really be very careful about trying to pass those laws ahead of the midterm elections when it seems like the administration's current focus is really on the affordability crisis, trying to lower mortgage rates and do other things to kind of provide relief for households that have been dealing with high inflation rates. So it would be a tough message to sell that we're trying to help you out over on this side, but we're also making everything that much more expensive over on this side.
Thomas, Rob, thank you guys both for your time today. Appreciate it.
Thank you.
Thank you.
Well, big oil executives are at the White House meeting with President Trump to discuss Venezuela's oil reserves following the capture of President Nicolas Maduro.
30 million barrels. I can't even, is that a correct number? 30 million barrels. You hear that, Peter? Of oil was given to us by Venezuela. That's a lot of oil. It's about $4 billion worth, and it's on its way to the United States right now. We're going to be working with Venezuela. We're going to be making the decision as to which oil companies are going to go in, that we're going to allow to go in. We're going to cut a deal with the companies. We'll probably do that today or very shortly thereafter.
Here with more on this meeting, we got Yahoo Finance reporter Jake Conley. Jake, what do we know so far? What did we learn?
Yeah, big meeting today. You've got close to 20 oil executives from the U.S. in the room with Trump. He says, and I'm going to quote this, we're going to be making the decision as to which oil companies are going in, and we're going to be able to allow to go in, and we're going to cut a deal with those companies. We'll probably do that today or very shortly thereafter. So Trump wants to see some of these deals for these companies, Exxon, Chevron, ConocoPhillips, some of the biggest operators in the U.S. He wants them in Venezuela right away. He says also these companies will be, quote, spending at least $100 billion of their own money. So not only does he want them in fast, he wants to see big spending from these companies to the tune of $100 billion.
So that's what Trump wants. But let's say you're one of these majors. I mean, you're Exxon, you're Conoco. What do you need to see before you're comfortable investing aggressively back in Venezuela?
There's a lot of things you're going to want to see. A, you're going to want to see security.
Yeah.
Plain and simple, right? You're going to want to know that not only are your people and your equipment going to be safe, but if you're spending $20, $30 billion, you're going to want a contract. You're going to want to know that contract's going to be honored if something goes wrong. You've also got to remember, oil companies think on decades-long timelines. They do not invest on this month or this year. They invest on 15, 20 years from now. Trump is only going to be president for 3 more years. So these companies are going to have to sit here and say, do we see stability, money, cash flow coming fast enough to justify spending $20 billion to get in on something that, if it's a good investment, we should be in for 30 years.
Well, we mentioned Exxon, we talked Conoco. What about Chevron? What's their role specifically?
Chevron's got the most interesting position here, right? Mike Wirth's company has been there the entire time. When Venezuela nationalized that industry, all other U.S. operators actually left the country. Chevron has been the only operator there operating under a carve-out from the U.S. Treasury Department. They've been the largest exporter of Venezuelan barrels pretty much that entire time. So Mike Wirth's company has resources, they've got people, they've got equipment on the ground. Who can tell how much money they're going to want to put behind this and whether they're going to want to start really ramping up their exports right away? There's a lot of questions around that, but they are certainly in pole position for this play.
Let me ask you, I'll get you on this. If you look big picture and you're sort of looking out 12, 24 months from now, what are the chances, the odds, or you actually do see, a significant ramp in oil supply out of there? And what would be the variables that depends on?
I think that would be really fast to see a significant upkeep. Right now, Venezuela is exporting around 1 million barrels a day, a little bit less than that. I've talked to some analysts over the last few days who have said, you might see 1.5 million over the next 12, 24 months if everything goes right. But everything has to go right. There has to be security. The industry has to clean up. You got to remember, a lot of this equipment has fallen apart in the Chavez and Maduro days, so you need quick infrastructure investment. Getting back up to 3 million barrels a day, where Venezuela once was, Rystad Energy has said that's going to take more than $100 billion, and it could take 5, 10, 15 years. It could take a long time.
All right, big story. Thank you, Jake. Appreciate it.
Thanks, Josh.
Coming up, we zero in on how options are trading. It's ahead of bank and airline earnings. That's next on Market Domination. Now time for today's trending tickers. Yahoo Finance's Brooke DePalma join me here for a look at retail stocks, Tilray Brands, and Mattel. We're going to start off here with retail. Several names under pressure as the Supreme Court holds off on delivering a ruling on Trump's tariffs. So no news is bad news, Brooke.
Yeah,
is that
that's what we're seeing in the stock reaction, at least based upon how investors are perceiving this. Ultimately, if there was a ruling that these were deemed legal, maybe there's a step back, that would ultimately mean an improvement within profit margins for these retail stocks like Kohl's, American Eagle, Under Armour, Lululemon, just to name a few. And those are some of the stocks that we're seeing the largest momentum or moves off of today. Ultimately, what I did after I heard this was I went through some of the earnings calls just about the impact that these tariffs have had on gross margins. And what we heard, for example, was Under Armour. They anticipate a decline of 310 to 330 basis points because of the impact of the new tariff costs. Kohl's, a similar message there about the impact on gross margins. Lululemon say they expect gross margin in Q4 to decrease approximately 580 basis points relative to Q4 of 2024. Largely because of these tariffs. And also American Eagle noted within their call about a $20 million net impact from tariffs. And so really, they just want some ultimatum here, some understanding. What's the end game here? What does this mean for consumer prices? And so what does this mean for their margins moving forward?
Yeah, it wasn't just retail. I saw some industrials with tariff exposure also slumping in today's trade. Turning to Tilray Brands, meanwhile, the cannabis company reporting second quarter revenue and adjusted EBITDA that topped Wall Street's estimates. Bloomberg analysts weighing in, Brooke, they said its diverse business mix positions it to capitalize on the burgeoning legal cannabis business worldwide while limiting, they said, its accompanying sales volatility.
Yeah, and what we saw was this company beat up on the top and bottom line, that they largely were led by specifically their cannabis and distribution business, outperform Wall Street's expectations for this specific report. And I drove into this earnings call as well, and something that stood out to me was the CEO said on the call, he said, the decision by President Trump to federally reschedule cannabis in the U.S. represents one of the most consequential regulatory shifts that the industry has seen in decades. Thank you, President Trump, if you're listening today. I thought that was really interesting. Basically, this optimism around what that rescheduling to, from what I understand, a Schedule 3, sort of a lower category for cannabis that they would be in, now they would operate in, and that means less regulatory concerns for this industry. And Tilray has been hit really hard. From the time that they IPO'd, they're down about 96%. So really looking for some momentum for the stock as well.
All right, finally, Mattel. Let's take a look at that one. Getting hit with a downgrade over at Goldman Sachs, the firm lowering its rating on that stock from buy to neutral. So Goldman, Brooke, they moved to the sidelines. They're talking valuation. It sounds like also a tough consumer backdrop.
Keep in mind, this stock has had quite the run. Over the past year, it's up nearly 17%. And so it's not like a stock that has been underperforming largely. That's pretty much in line with what we saw with the S&P 500 during 2025. But also, there are some puts and takes when it comes to Mattel and the enlightenment, the heightened opportunity that it's seen over the past few years with lots of toy movies that have done really well, like that Barbie movie that really came into clutch for them, that really led to higher sales. The note also saying that recent toyetic films have not had as material of a benefit on revenue trends as previously expected. And so definitely one to watch, especially they're behind toys like Cars and Barbie and other names. They're definitely in vogue, but I guess just not enough.
Yeah, I'm just looking here. The street here, 9 buys, 6 holds, no sells, average target 24. Thank you, bro.
A bit above that $21 where it is now.
Time now for what to watch. Markets are waiting on a key decision from the Supreme Court on the legality of President Trump's tariffs, and Wednesday could be that day. The High Court will release its next opinions then after declining to issue a ruling Friday. Another big focus for investors, the start of earnings season. It's here. Big banks kicking things off to start on Tuesday with JP Morgan Chase ahead of the open. Analysts expecting trading revenue to be up year over year and investment banking fees to rise modestly. Other top bank reports to watch over the course of the week got Bank of America, Goldman Sachs, Citigroup, Morgan Stanley, and Wells Fargo. Outside of financials, we're also going to check on the consumer with Delta and a look at the AI trade with Taiwan Semiconductor. We'll also get fresh readings on inflation with both the consumer and producer price indices coming out. Economists see December CPI coming in at 2.7% on overall and core CPI on a year-over-year basis. That data, plus the December jobs report, will be in focus as we get a big batch of Fed commentary throughout the week. There are over a dozen speeches. Expectations for a rate cut we know in January are almost zero, but directionally, investors looking for hints on when the next cut could come. Finally, crypto investors keep an eye on Capitol Hill. 2 markup sessions placed simultaneously on Thursday on crypto market structure legislation. We're wrapping up today's market domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.